Hey everybody, welcome to this video. This is Shane Smillian from Wolf Trader Features, and today we're going to dive into the fascinating world of financial astrology with a quick look at the Bradley Barometer. So this is a unique tool that blends planetary movements with stock predictions. I have a graph here of the S&P 500, but we're going to break this down just to kind of talk about what this is. So what is the Bradley Barometer? It's developed in the 1940s by Donald Bradley. The Bradley Barometer is also known as the Bradley Siderograph. It's a financial astrology indicator used to design market forecasts and turning points in the market. Um, there was a time when this Bradley Barometer worked very, very well before the Fed got strong on the markets. But it's still worth looking at, especially when the Fed is strong, because you can look for low points of the market. And people still ask me about this. I don't even put this in our calculations, to be honest with you. I don't think we need it. I have 4 other Astro and cycles that I put together, but I'm going to look at this today. And the Bradley Barometer tracks angles aspects between planets. Positive aspects like trines and sextiles give positive values, suggesting bullish market vibes. Negative aspects like squares and oppositions get negative values, hinting at bearish trends. These values are combined into a single line called a Siderograph, which oscillates to show potential market turning points. So we're going to build this real quick here on the chart. I'm using Alfie's program here, Market Trader Titanium. So the Siderograph doesn't predict exact prices directions. It's more like a psychological windsock. Uh, the idea is that when you have uh, markets and you have uh, the market acting on pure psychology of natural forces, that these transits are going to affect the markets. So they're more like psychological winds that can show sentiment due to planetary influences. Peaks and troughs often align with market reversals within a window of plus or minus 4 days. Though inversions, people talk about these things called inversions. I'm not a big fan of inversions. So inversions basically mean that when we talk about a turning point in the Bradley, it can actually be something like it can mean the opposite. So sometimes we can see that. This is the 2008 2009 financial graph that I have here. But um, inversions basically say that it doesn't matter what direction the Bradley is turning, it just matters that any turn, a turn causes essentially a turn in the markets. So I personally don't like the concept of inversion because I think it's kind of like a cop out. Like you can say, well, it didn't work, but it was inverted. That's not to say that inversions aren't real. We don't want to get too strict about this. Inversions can happen a lot of times when you have retrograde planets. So retrograde planets can cause these inversions to occur more frequently on the market. Now, this is a case here where we have 2008 here, and the black line here is the S&P 500, and the blue one here is the Bradley. And so you can see that uh, before the Fed gets involved in the markets, this was actually a really good tool, and this was used a lot by Arch Crawford, who is Larry's friend, and he did a really good job of forecasting the markets with this. And the sad thing is that what once worked so well for the markets just doesn't. It just you really have to be careful with the Bradley now, um, especially when the Fed's involved. So this is really around the time of the financial crisis. So down here you can see this is 2009 down into here, and you can see this is the 2000. This is the crisis into here, and this was a time when the Bradley worked well. The Fed wasn't that strong yet. I mean, the Fed really started with QE0 right into here, into this October-November period. QE is quantitative easing, and so this was QE0, and so. Um, I've done videos on this. I did webinars about this, that when the Fed gets strong, this stuff doesn't really work as well. But we can still look for lows for this. But like I said, this was kind of like the last hurrah of the Bradley here, where the market was primarily natural forces up to this point. Now we're just into this whole craziness with the Fed. But this is so you can see the Bradley here going down, and you can see that the stock market was also going down with the Bradley. It was a pretty good. The Bradley does turn up sooner here, a little bit sooner. The market goes down a little bit more into here. And then this is when we started to get QE1, like the QE1, I call this the true QE, was right into here, and that's when the market started going up. And a lot of people had a real easy time forecasting this low. It hit a lot of very important Fibonacci retracements, extensions. It was a very logical, quote unquote, logical low into here. And then the Fed also cemented this into here. And you can see the Bradley goes up here, and then the Bradley starts to fall here. And this was a phase where the QE ended and then the Fed, where they were starting to try to taper on the market. And right into here, they were going to try to sell off the bonds right away, basically, because I think Bernanke thought this is going to be temporary. We're just going to buy these bonds and then we're going to sell them back. And then he said, he said, no taper. We're not going to taper this thing off. We're not going to sell them off. Not going to sell. And then the markets took off again, and then they started the news of they started this news of QE2 over to into here. So this is like the whole history here. I'm going to see if I can move this over a little bit so you can see more of what we're talking about over to here. So there's, like I said, this into here was so the Bradley goes bouncing here. The market goes down a little bit more than it bounces with the Bradley. Bradley starts to fall here. Now notice when the Bradley turns here, all of the sudden, you can see all of a sudden, the market doesn't care anymore, right? It just doesn't care because the Fed started with quantitative easing into here. It doesn't care. So you have all of these movements up here. And then we got into this period here where Bernanke was going to try to actually, like I said, sell off the bond, but he didn't because he realized once he started selling them off, the market started to fall. It was crazy. So this is when I just talked about this a second ago, but we can see this now on the graph. So this is when he was like, we're not going to sell it off. The market responded with a big rise up, and then there was a QE2 rumors into here, and we started this whole craziness where the market really just started having a mind of its own, just following what the Fed did. And that's kind of like the end of the natural forces into here. And again, I've done a whole history on this. I've gone through and looked at every single Fed operation from the beginning. I've done very detailed analysis of this, and there's really no exceptions to this. When the Fed gets strong like this, these natural forces just don't work as well. But it's still interesting to look at this. You can see into here that even when the Fed is getting strong into here, what you want to do during these periods is you want to look for periods where the Fed is, or Bradley's making a low. Okay, so the Fed's getting really strong into here. Okay, you want to look for these periods into here where the Bradley's making the low into here. Whoops, let me zoom out again. Sorry about that. This is real-time software here, guys. This is the real thing. Market Trader Titanium. This is like the most sophisticated astro software there is for financial astrology. It's a lot to work this program, trust me, but we're just going to go through this step by step here. Um, So again, you can see there are times here where, the Bradley is falling. The market has very limited reaction to it just because the Fed's so strong. And then you look for these lows. So when the low comes in on the Bradley, that's when the market really takes off. So it's not that the Astro stuff is completely wrong. It's just we need to understand that the bias becomes very bullish. And so you want to look for these times when the bias is bullish. Now, you can actually have the opposite effect. You can have a falling Bradley and a rising market if the Fed is really strong. So again, everything's in the context of what is happening with the Fed, and this is why we've studied this in such detail. And like I said, we've gone through every single operation. Like I said, there's many webinars about this, and so this is going through into 2011, 2012, into here. Um, and you can see, the main thing is to look for when you have these lows when the Fed is strong. And then this period into here, 2015, this is actually a period where the Fed starts to get weaker, that this can actually have some drawdowns. But pretty much when the Fed's getting strong into there, there's just not much you can do. If your Fed gets kind of neutral, you can see it can kind of have these periods where it can follow the market, can follow the Bradley, but for the most part, I don't use this indicator anymore for financial markets. I just don't. So this was COVID back into here. COVID was an interesting situation. We did get a lot of astro turning points. There was a stellium into here into COVID. So the Bradley was in general weakening into here, and then it did get stronger into here. But you have to understand the Fed also started with QE into here. This huge unlimited QE in the repo markets and the TALF, and everything was going on into here. with this big rebound. And so this is the other thing too that you have to understand, that the market has nothing to do with the economy anymore. Like this, the economy was basically shut down into here during COVID, and the markets were able to rally because of the influence of the Fed. So, like I said, we play this stuff with a grain of salt. But the Bradley, like I said, it's just becoming less and less of a tool to use, unless you're looking for lows. Unless you're looking for lows. If you're looking for lows and the Fed is strong, it can be a useful tool. But it's just not like it was. I mean, you can see into here, it just hasn't been tracking like it did. If you go back to, like I said, go back to some of those early dates into the financial crisis, it's just pretty crazy. Now, some people would argue that the Bradley will work very well when the people are emotional in the market, and that might be true. I mean, it might be during emotional times they might revert to the Astro, because the Astro is, the theory is that this tracks the mood of the people. But I can just tell you, I mean, we can go back in time and look at this, and it had just been a much better oscillator. If you go back through time, you'll see the markets generally following the Bradley um, before this 2009 period, this market low. So this is when everything in the markets changed. I know we're getting into AI now, with everything going on with with Nvidia and this whole AI movement. But really, I think of this as like the first tool of intervention here back into 2009, where we really started intervening on these markets, and with these massive injections, and it fundamentally changed the Astro. And this really had caused me to change my perspective too, because I had really thought that I had figured out this from an Astro perspective, and then this QE would come in and everything would stop working. So at least now we understand what's going on, but that's just kind of the introduction here to the Bradley. In the next video, I'm going to talk to you about where the Bradley is going right now, into the last part of 2025 and into 2026. And of course, we will be looking for the bullish aspects of the Bradley, because the Fed is so strong right now. So that's how we'll take a look at the Bradley, and I will talk about that, like I said, in the next video. Until the next time, hope everyone has a great evening, and remember to follow the Fed juice. Have a great evening.